Okay, welcome. It's another Sunday. So let's talk about what has transpired over the past week. About 2 weeks ago, I highlighted a bunch of flow that came in that was very suspicious and bearish. Um, and we saw not small amounts of money, but pretty substantial, large amount of money betting on out the money contracts on SPY for 629 puts December 19th for 4 million. Another 628 for 800,000, December 19th, 628, another 800,000, December 19th, another 4,628,000 puts, another 4,628,000 puts. And these were all towards the ask side, which means that they were bought to open, not sold to open, which means that their bearish positioning was indeed true. And then you can see another one down here. Now, this past week, we have also seen resumption of such flows again. I can go through that on a separate time, but because I have to dig through all of it, I don't want to take up too much of everyone's time. After seeing all of this and the econ data and the macro scenario that we spoke about, I also cautioned you guys on this message that I wrote on Discord, which was nice move on NVDA earnings, single-handedly carrying the market up. But remember that we still have the NFP, which is the non-farm payroll. This coming out of a situation where we had already people taking profits off the AI fears, right, which we saw for a couple of weeks. And then at the same time, people kind of piling into downside hedging flows, which increased the propensity for people to then buy more put contracts, which is what we were seeing in the flow. So my simple, humble advice last week was that please be careful. We are not out of the woods. And that was when we were right here. Now, at this moment, when NVIDIA's earnings came out, you guys need to realize that the market had already seen the earnings and they had a relief rally heading up into the key level on SPX, which was a very, very important key level for Thursday and Friday. Thursday for me, Friday for me, Thursday for you guys, right? And the focus here was that if the NFP came out worse than expected, then what's going to happen? Failing to do so, crossing over the key pivot will send us back to the golden pocket for a retest. Now, intraday, we had this move. Exactly back into the golden pocket and then bouncing off it, right? Really, really simple. So now, a lot of you may be like super confused, and I understand that because you're trying to be bullish in a bearish market, and that's just swimming against the tide, right? So you might be feeling some type of way right now where like your brain is thinking one way, but then your body refuses to follow through on the commitment towards a new bias. And I must tell you that over the many years of doing this, the best thing that you can do for yourself is if you feel uncertain, then just stay out for a bit and see how it plays out. The second best thing you can do if you still have a conviction and you're willing to explore the other opportunity or the bias side, right? Then you might want to switch your bias, but you have to switch your bias intelligently. You cannot switch your bias while you are moving in a wave down because then you are priced out, right? For example, case in point, if you are in leverage shares right now, right? You should wait for a pop and then you should aim to de-lever the position. Because remember what I've spoken about with leverage shares, you have to be careful. When you have leverage and the market's moving up, it's working with you. But if the market's moving down, it's going to work against you. So what you think is your 2x, 3x leverage on the way up becomes minus 3 or 4x leverage on the way down because now the liquidity concerns are there, right? So let's get into the macro before I align it with the technicals and give you guys my bias for the week. The first thing that you guys need to understand is that we have a very, very clear understanding of how this market is kind of moving in a new rhetoric. The first thing that happened when we had this very big buy up here was a bunch of people were taking profits on their position. And then another bunch of people decided to take profits on their position. It is only until last Thursday and the whole of last week that the macro piece of this has been deteriorating. And as I was mentioning during today's fireside chat, there is one piece of advice that I have to give you guys which is don't fight the Fed. Trust me, it never ends well. You will never win this fight if you're going to fight the Fed. If the Fed is projecting that they are not going to cut interest rates, then follow what the Fed means, because the Fed says what it means. They are non-incentivized in painting a picture. They are decentralized from the government. That's what the Federal Reserve was built to do. More importantly, the Fed has unlimited amount of funds to battle the stock market sentiment. Okay, so even if we have a long bias in the short run, we have to be very careful with our long bias if that long bias is butting heads with the Fed decision that's about to come up. Okay, because I can tell you right now that if you look at the CME data, which last week was a bit better, and then this week is a bit better too, you can see this is where we are currently, right? The market is pricing in a rate cut for December. This was assumed for a long time already. Last week, this went to 50%, I showed you guys. And now it's back to 70%. Now, as I mentioned in last week's session, the market is not focused on this piece of data. They are focused on January and March, because what do we know about markets? They are the leading indicator of the economy. In other words, they're pricing in what is about to happen 6 to 8 or 6 to 9 months from what is now, right? And if you go by that rhetoric, you realize that the January rate cut is currently sitting at 58%, and the March rate cut is, rate pause, right? Rate pause is 58% and 42%, which means to say that in next year, the beginning half of the year, Q1, we are not expecting rate cuts. This is the crux of the matter. We went from a place in the end of 2024, beginning of 2025, for having 9 rate cuts on the table, to then going through April, where tariffs came in, where Liberation Day came in, and then the market repricing that to 3 to 4 rate cuts. And then is when I mentioned that this will not end well. We will likely only see 1 to 2 rate cuts by the end of the year, which is exactly where we are right now. You have to realize how to piece all the pieces together to see where the Fed's projection is and where the market sentiment is, to put those two things together to see where they will land and fall. This takes intuition and it takes many years of experience. I don't think that many of you should even think of being accurate about it, because there's no point of being accurate about it. The point is, you need to look at the data and understand what is going on in the background, right? So the deterioration of expectation for interest rate cuts next year, which is a long-standing idea and something that I've been mentioning for a very long time, that after the Fed cuts rates, that is when the real fall is going to happen, is coming true, right? Now, knowing all of this, you need to understand that while this profit-taking wave happened, a bunch of Fed speakers came into the market, yes, last week, and they all came out with a bearish rhetoric. This is the reason for the sell-off that we saw very abruptly, amongst other things. There were a few other things that happened all at the same time, okay? And then we saw hedging flows come in. Hedging flows ahead of the Federal Reserve interest rate decision, which is happening December something. It's December 16, December 15, somewhere along there, okay? So we know, this is not a secret anymore. We know that there are market players, institutions, whatever they are, that are positioning for a broader downside move. Does that mean that SPY will go down to 629? We don't know. In fact, I'm very, very willing to tell you that if SPY goes down to 629, they would be out of their trades way before that, right? But they are definitely looking for a negative gamma move. And they may have gotten that last week, but I don't think it was enough for them to take profits off that position. So therefore, obviously, today we will know again, based on open interest on when it comes out, I'll post it on my Discord. But you will know whether they're still in those positions and whether they are actually still taking profits or they're still kind of looking for that downside play. And if we are looking into the next month, which is December, we are likely to see the market solidify its position about a hawkish cut. What does that mean? That means that Jerome Powell will come out to do an interest rate cut, but then during his press conference, he will take a hawkish stance, which means we don't have enough data. We don't feel it's appropriate for us to cut interest rates into 2026 January, March. And he might go as far as saying that the Fed has its work cut out for itself, and it's a very difficult situation because of government shutdowns and data not being present, and so on and so forth. Now, if he does say all those things, how do you think the market's going to react? Probably unfavorably, right? And this is the scenario the market is pricing in now. This is all you need to understand. Long term, this will all pan out. It will all rectify itself, and then eventually the market will rebound and go higher. But for right now, in this next couple of weeks, I do intend, and this is my bias, I do intend for prices to come down a bit further so that we can really create some panic and fear, which is already pretty high. And we usually say that because in a moment like this, where there are so many people who are looking for a bullish move, fate loves irony, right? It's always like that. Well, while we are always biased to the upside, we always have to take a step back and realize that things can go to a dark place, but not to fret, because you need to understand something. When that move happens, you're going to have the best Black Friday sale ever. And that is what you should be all focusing on. It's how am I going to position myself to take advantage of a drop if it comes, and what am I going to buy in those moments that is going to defend me in the first half of 2026. Okay? This means that you're looking at very good quality businesses that are inflation proof, that are recession proof, which are non-sensitive to Fed rate changes. There are very few of those, but I will go through them eventually. Okay? So, having said that, I also want to go through the technicals and kind of give you guys a lowdown on what's going on here. So, if you look at what happened on Thursday and Friday, right? And I just want to very quickly turn on the moving averages for a second, because remember, we don't use moving averages on a daily to day trade because it is a lagging indicator. However, moving averages are a very good way to tell you where the trend is, right? It helps you kind of visualize whether the trend is moving down or it's moving up. And while it is lagging, it gives you the direction with a little bit of a lag, but it at least tells you the direction, right? And so what are the rules of moving average? We know that when the short-term moving average, in this case, my red line is the 50 moving average, my green line is the 150 moving average, and the blue line is the 200 moving average, right? If the shorter term moving averages move above or below the longer term moving averages, that causes a change in directional bias. And you can see that actually up till last Thursday or last Friday, we were not actually in a bearish move yet. We were getting there. We were like getting there. We were kind of here. And then, you could have gone out here once again and gone back up, right? But now, as of that day, and then the trading days that followed after that, right? You can see that the 50 moving average is now crossed below the 200 moving average, and it is moving quite alarmingly down. Now, this doesn't mean that this can't snap pull back this week and go back higher, which I'm about to get to in a second. But this is showing you how the trend is shifting. You have to be aware of this. Okay, so I'm going to turn off the moving averages because they're not there for me to do my analysis. They're only there to tell me where the trend is shifting. This candlestick here, the huge bearish wave candlestick that sent us back into the golden pocket, was a very, very important candlestick because it gave you a lot of information on how many people were able to defend this. If you look back on the 15-minute chart, bulls were barely able to defend this, and they were only able to defend this when it got into the golden pocket, after which coming back out. So for this week, I have a very, very simple plan, okay? While we may get a move back to retest 6,700, and I will tell you what that level is on SPY. It is going to be 668, right? while we may get a move back to retest 668, our key area that bulls need to secure in order to send this way back up is this 674 to 676 area. We need to firmly break out of this and bounce on this level in this area in general for us to have a chance to push this back to all-time high. Otherwise, it is very likely that the acceleration of the bearish flow continues. Now, I also want to bring your attention to other forms of data that we've been following, like the CTAs, which I've been talking about, they had almost $280 billion to sell no matter what tape conditions last week, which is the reason why all of this was adding together in a form of conviction for me as well, right? But if we are unable to break this, and we are unable to break 668 first, then this is going to send us back down into first 643.20, which is the golden extension, 61.8 extension. Okay. What comes below that, you may ask? Well, assuming that we break this 650 here and then breaking the 646, which was another previous low here, and then breaking 643, well, that now opens us up to 632 to 636, which is a little ways down from there. That would mean that the flows that I've been highlighting would then become true, because they will definitely take profits off by then. They don't need to get down to 629 or 628. They're just betting towards that general strike. So by then they would be out of the contracts completely. Okay. So having said that, my bias is still bearish this week, because the price action is dictating that we should remain biased until and unless proven otherwise. The key pivot, which needs to be breached on SPX, for example, is 67.78. And that's pretty high, right? Okay. So having said that, the bullish plan is outlined, and then the bearish plan is kind of outlined. My next question that I want to answer, because I think a lot of you might be thinking, is, so should we hedge? Right? Should we hedge our positions here? Well, the short answer is, if you do not get up to 675, or like basically, if you don't make a big move up, I don't think you should hedge. Okay? You should let this just fall without hedging. Now, if you want to day trade a short position and you want to swing trade a short position, that is completely different. Completely different outcome, completely different situation. However, don't count that as a hedge. Your day trading for a short term is not a hedge. A hedge is in a situation in which the market's overextended and you're trying to protect profits. If you have a position that's in deep profits and you're trying to protect it, that is the definition of a hedge. Okay? So therefore, if the market moves higher here into 6760, 6720, this general area here, and then you want to put on a hedge, that might make more sense from a risk to reward standpoint. But if you're going to tell me that when the market opens and you see a rejection here and then you hedge, let me tell you, I don't recommend it. And there's a very simple reason for it. Because the puts skew on SPX and SPY right now are already very saturated. So therefore, a lot of people are already in this position. You can see that as evidence from where the VIX is. It is currently sitting at 24, which are slightly elevated levels, which means the implied volatility of all contracts are higher now. Therefore, if you're going to enter some put positions right now as a hedge, I don't recommend it until and unless price action expands further up, right? SPY moves up to, for example, 668 all the way to 676, this area here where I was talking about, and then rejects there, and then you're like, okay, now I want to put on a hedge. That makes more sense. But nowhere in shape or form should you be hedging down here, because your risk to reward ratio, let's have a look at it. Just remember, this has nothing to do with emotions or the data right now. I'm only going based on risk management here. So let's have a look. Let's say, what is SPY opening up here today? SPY is currently trading at 662, right? So very quickly, I'm going to run through this exercise with you all so you can understand. 662, right? Let's say we are here. And let's say tomorrow we see the rejection here and we decide to take a short position. Okay. Well, guess what? Intraday, if our bullish outcome plan is that SPY can potentially go up to 672 and it can go as low as 650, then what is your risk to reward ratio here? 0.89. That is terrible. That is not a trade I would put on, right? Now, if instead you were entering up here and you were targeting this low, your risk to reward ratio now becomes 5.68. So you can see very quickly that just your entry into a position changes your risk augmentation of the position. And you need to be very quick to understand how this can go good or bad in a very short period of time. This is the reason why I keep telling you guys, keep your emotions and your bias in check while you're doing market hours, because it can very quickly get to you. And when you are trading based off emotions, you're going to make stupid mistakes. You have to always make it mathematical and try to understand it from a statistics and probabilistic perspective, rather than looking at it from I think it's going to do this, I think it's going to do this, I think it's going to do this. That doesn't work. Now, this is further personified. This entire technical structure is further personified by NASDAQ here. And you can see that this was your previous lows that we have been finding support at. And you can see that we found support here even very recently. But somehow, by the close of Friday and today's session, of course, we'll see where we open up pre-market, we have not been able to get past this, which if we get past this, then we are likely heading into here and then into here. So our upside pivots are all here, but remember, bulls need to secure this here in order to have a clean move to the upside, okay? And on NASDAQ, you can kind of technically go down all the way to 23,000 here, which is the equivalent of SPX 6360, okay? So very, very clear plan for this week. Our long-term bias stays the same, right? We expect that after this whole correction happens sometime in December and we are done with the selling off and all of that, then yes, market's going to reverse and go higher as usual, as it does 3/4 of the time. But for right now, you have to be cautious because the macro has changed. And I've pointed this out for 2 weeks in a row now. So remember to cap your bias. Cap your bias and remember to look at it from both perspectives, not just the bullish bias, but also the bearish bias. And that's what the same message that I sent last week, the same message I'm sending this week. And that's all I have for you guys. Few little tidbits that you guys should also be watching is the VIX. If it goes higher here, it will break 29. Then real fear starts to kick in, right? You will see that it will start to get up to the 35, right? And if you look at the US 10-year yield, it's moved further down. So this is where that expectation of the interest rates came from, where December rate cut is now being priced in. But then at the same time, the January and March one isn't. And then the last piece of the puzzle, which is the dollar, which I have been putting your attention towards, if it breaks out of this key level at 100-ish and starts heading up to 101, then this will create further downside pressure on the stock market. And remember that if the Fed withholds interest rate cut and says we're not doing so many, what does that mean? The dollar is going to go higher, right? And if the dollar goes higher, then what happens to gold? Gold comes lower, right? So you can see how the entire picture plays out when you look at it from the macro big picture view. And I want to also, one last final thing. When in doubt, and you're looking at this chart and you can't figure it out, you guys should really toggle to a higher weekly time frame. I don't know if many of you are doing this, but look at the weekly chart on SPX, right? You had your April, you had a big run, bulls secured this market, so let bears have their little fun, right? Let bears have their little fun. You'll come down to here, or you'll come down to here, or you'll come down to here. That's not too bad. What is that? Look at it from a practical standpoint. What are average corrections in the S&P 500? They are between 5 to 10%. What are we at right now? 4%. If we got down to here, we would be at 8%. Still well within corrective territory. So there is nothing to panic about. There is nothing to be uncertain about. If a bear move comes, it comes, and it's for good reason. It's because we need to shake out people. We need to instill some fear and panic to get people who are not serious about the market out of the market. And that's when the real move to the upside happens. And that's all. That's all you need to know for today's session and my weekly prep for this week. Okay. I hope that was helpful and helps you to kind of keep your head and your mind in check, and your heart in check, right? Remember how I keep mentioning during the fireside chat, you need to learn to observe your triggers. Your triggers, which happen on a daily basis, when the market's moving down and you're like, oh, this is happening. What should I do? This, your brain's going all over the place. Take a step back, observe it. Realize that, okay, this is what is happening. I need to react this way. I need to take a step back. I need to walk away. Know what is best for you and operate within your operating system. Okay. That's all I have in terms of my weekly breakdown. And also remember that we still haven't seen improvement in repo flows here. So no Fed plumbing has come through, right? Some of this data is still delayed. NFP just came out, right? This was, no, it's not come out yet. Yeah, this was a September reading, correct. We will get October and November very soon. Remember, that also is on the table. That's coming out after the Fed meeting, the next Fed meeting. Remember, I mentioned that already. The next economic data is coming out after the Fed makes its decision. So the Fed will be going into the meeting dark. They will not be knowing the data before it comes out, right? So understand all of these things are going to cause anxiety. They're going to cause the market to feel a different type of way. And we need to be aware of that. And that's all I have. And you guys can have your questions if you need them answered. I will end the recording here.